Okay, let's continue. Okay, let's start with e-commerce. Amazon relies heavily on AI to improve its efficiency and customer experience. For example, Amazon uses AI to provide personalized recommendation to users, which will help improve user satisfaction and retention. Besides, the e-commerce company uses AI in almost every aspect of its operations, including warehouse operations and logistics with the help of AI. Amazon can do more work with fewer resources, and the benefits flow directly into its top and bottom lines. While the impact of AI on Amazon's e-commerce business is indirect, AI's influence on Amazon's cloud computing business is direct and far-reaching. Hmm. One thing is that implementing AI in enterprises will naturally result in higher demand for computing and storage capacity from AWS. Besides, AWS can provide the various AI services such as machine learning, computer vision, language AI, etc., to help enterprises get up to speed with their AI implementation. These services will continue to expand in the coming years, assisting AWS to gain market share of enterprises' IT budget. In short, Amazon stands to reap enormous benefits from the uses of AI technologies and by selling these technologies to clients. Amazon's optionality on AI. Amazon has benefited over the years from the advancement of AI, but the best days of AI lie ahead as technology continues to evolve and mature. The improvement in AI technologies and algorithms, the advancement in computing power, the exponential growth in the availability and quality of data, and the emergence of new business models mean that the prospects of AI will inevitably improve over time. This matters to Amazon since it is strategically positioned to benefit from this optionality. To this end, Amazon's culture of experimenting with the latest ideas, product innovation, and customer centricity provides the proper foundation for developing and launching new AI products and services. Besides, Amazon has access to a wide range of data through its e-commerce platform, AWS, Alexa, and other subsidiaries, serving as a valuable resource for improving AI algorithms. And let's not forget Amazon's other valuable resources such as cash in hand, customer relationships, and partnerships, which will be critical in developing new AI product solutions. While it's too early to pinpoint precisely which area of AI Amazon will benefit most in the coming years, some areas of speculation include robotics, autonomous vehicles, smart home and IoT, hmm, and personal virtual assistant. In summary, the future of AI will be massive, and Amazon is well positioned to benefit from this optionality. Amazon stock is available at a reasonable price tag. Usually investing in an up and coming trend like AI will require investors pay a premium for companies in this industry. For example, AI related companies like Palantir Technologies or C3 AI come at a hefty price, currently trading a price sales ratio of 18.4 and 10.1, respectively. Besides, both companies are profitable, which is common among these emerging tech companies. Thus, investors usually end up with a high risk investment when betting on these companies, a proposition that is unattractive for conservative investors. Fortunately, investors don't have to incur such risk when buying Amazon stock. Amazon has a PS ratio of 2.5 times, which is lower than its 5-year average of 3.4 times. This ratio compares favorably with those of Palantir C3.AI. On top of that, Amazon is a well-established, profitable company when Amazon investors can have their cake and eat it too. Amazon is scaling back capital expenditures and cutting headcount. The company delivered an excellent quarter report showing the strategy is paying off despite the cost-cutting. Revenue grew at an 11% rate. This tech and e-commerce giant has it all. Let me be clear, owning more than just one stock is essential indeed. Diversification alone can prevent some of the worst blunders for the average investor. However, just for a moment, let's contemplate a scenario where an investor must, for whatever reason, own no more than a single stock. What should they choose? In my opinion, there's one name that stands out: Amazon. Here's why. Amazon's massive investment cycle is drawing to a close. The COVID pandemic was a severe jolt to the world economy, and as a result, many corporations shifted gears in a stunning fashion. For Amazon, the pandemic created a boom in demand. As a result, the company ramped up capital expenditures. These purchases of buildings, vehicles, and equipment were meant to cope with the staggering e-commerce demand in light of pandemic social distancing products. No. However, as the pandemic waned, these investments ate away at Amazon's free cash flow, lowering it from $27 billion in 2020 to almost $30 billion in 2022. At any rate, CEO Andy Jassy had made it clear Amazon is scaling back. Over the last 12 months, capex spending has fallen from $66 billion to $59 billion as Amazon closed or canceled nearly 100 construction projects. Uh, Amazon's cost cutting has paid off. In addition to reducing capex, Jassy is also reducing cost. In a bid to increase Amazon's profitability. For years, Amazon's total headcount marched higher without hesitation, and during the pandemic, total employment truly ballooned. Mm. Yet this year, Amazon's headcount decreased for the first time in at least a decade. Total employees. Uh, as a result, profits are up in the most recent quarter. Uh, the 3 months ending on June 29, Amazon blew away expectations. Highlights included the following: earnings per share of $0.65 per share, nearly double consensus estimate. Uh, Operating margin increased to 5.7%. Free cash flow of $3 billion, the first positive free cash flow. On top of all that, Amazon didn't sacrifice growth. Quarterly revenue increased 7% from a year earlier. Thanks to the company's cloud segment, Amazon Web Services, and its advertising segment. Both things continue to grow faster than the company as a whole, with AWS recording 12% year-over-year growth, and advertising growing at a blistering 22% rate. In short, Amazon gives investors a little dash of investing they need. It has growth, profit, scale, and solid management. Moreover, its diverse business segments range from e-commerce and entertainment to cloud computing and digital advertising. That variety means that company can withstand shocks in one sector and keep chugging along. To sum up, no investor should put all their eggs in one basket and only own one stock. But if I were forced to, this would be the one I'd own would be Amazon. One magnificent Warren Buffett shot to buy hen or fish right now. The current valuation offers a discount compared to the past. Scale advantages and network effects bolster a strong competitive position. Berkshire Hathaway, headed by legendary investor Warren Buffett, isn't known for being especially keen on tech stocks. That the conglomerate has a tiny stake in none other than Amazon, which is worth $1.4 billion as of this writing. I think the smart move would be for individual investors following Buffett's footsteps and buy shares of the e-commerce and cloud computing FinStop. There are three reasons why: strong growth prospects. Amazon is unique in that despite its massive size, it posted trailing 12 month sales of $538 billion. Well, it still has ample growth opportunities, Amazon has that growth opportunities, right? Investors know that the e-commerce operations are the company's bread and butter. After all, Amazon helped spearhead the growth of online shopping, and today nearly $4 out of every $10 spent online in the US happens on Amazon's website. That happens that much. Online shopping happens that much, okay? That's certainly a clear indicator of the company's dominance, you know. But due to the fact that 85% of shopping still happens in person in this country, there's a lot of growth runway. So there are a lot of rooms to grow. You know. Amazon also has a leading and cloud services platform, called Amazon Web Services. Its quarter second 2023 revenue of $22.1 million was up just 12% year over year, continuing a notable slowdown from previous years. But AWS has a 32% market share on a global level, which is well ahead of the next largest rival. According to Grand View Research, the industry is estimated to be worth $1.6 trillion by 2030. If Amazon simply maintains its position, revenue is set to soar. Thanks to AWS having an operating margin that averaged 24.7% in the past 4 quarters, as this segment becomes a more important part of the overall business, Amazon's profitability will increase. With Prime Video, which commanded 3.4% of TV viewing time in the US in the month of August, the company has a serious contender to continue benefiting from the rise of streaming entertainment. Amazon purchased MGM Studios early last year, giving a boost in content production. Another secular trend helping Amazon is digital advertising. Many investors probably don't know that the company generated almost $11 billion in ad revenue last quarter, up 22% year over year. All of this growth pillars give me confidence in the trajectory of Amazon's operations looking ahead. Wide economic mode. Amazon's competitive positioning is bolstered by the presence of wide economic mode. The company has favorable traits that should keep it dominating the tech sector for a long time. Amazon has one of the most valuable and widely recognized brands on the planet, thanks largely to its customer base of millions of consumers and businesses, and by operating various internet properties. The amount of data the business collects has created an advantage in the form of an intangible asset that is almost impossible to replicate. Amazon's massive e-commerce marketplace has strong network effect. As more buyers and sellers join, it merely increases the value proposition to existing new users. This creates a virtuous cycle that becomes unstoppable. And by having a cost advantage, Amazon is able to serve our products and services at better cost than peers. For example, a huge logistics footprint consisting of warehouses, trucks, and drivers help push down shipping costs due to how much volume Amazon has. For companies that sell far fewer products, it might not be as financially sound to focus on fast and free delivery. Amazon's sheer volume gives you the upper hand. This business has been one of the best performing stocks in the past, rising 768% in the last decade and 58% in this year alone. Despite the huge gains, shares appear reasonably priced right now, trading at a price sales multiple of 2.5 compared to trailing 5-year average of 3.4. The current valuation looks like to be a bargain. As rare the investors are presented with the opportunity to buy such a dominant business with strong growth prospects, plus its wide economic mode, it sports attractive valuation. Perhaps it's best to copy Berkshire and add Amazon to a portfolio now. Okay, this is it today, and I do it really short, right? because I had to go to bathroom. I came right back in, but yeah, that's what it is. Anyway, see you and have a good night. Okay, today this is it. Okay, bye bye and have a good night. Bye bye.